Welcome everybody. We're gonna just give it one minute or so to I see people are hopping on pretty rapidly. So we'll get started in just 1 minute. All right, we'll go ahead and get started. This will be recorded. So if any of you have to run mid presentation, feel free to shoot us an email and we'll send you the recording. So we're here today to discuss really the performance of the Trion Multifamily Opportunity Fund 1. We launched this fund in 2016 and we closed it to new investments in 2018. This was our first fund, and this investment raised about $13.5 million. I believe it was the exact number was 13.45, and it was invested in 8 assets in Greater Portland, Oregon, primarily the western suburbs, and then also in the East Bay. So not in San Francisco, but across the Bay, in more of the working class suburbs. And with Fund 1, our strategy was really, to do just that, to acquire underutilized assets in the first ring suburbs of Portland and the Bay Area, and then convert those assets to more modernized, desirable housing through heavy renovations, rebranding of the properties, and very hands-on management. So the really thesis was in the Bay Area, we were in the East Bay, in the more affordable submarkets. So there's a real demand there for B quality housing. As many of you know, many of you are California residents, you can't really build B quality housing in this state. If you're going to make something pencil, overwhelmingly, it needs to be luxury housing that achieves top of the market rents. So our real strategy in the Bay Area was to find 1970s properties that hadn't been renovated and to convert them, to put in new kitchens, new stainless steel appliances, a vinyl plank floor, and really just take kind of like a C plus asset and convert it to a B plus asset. And we had a lot of success with that. The fund has, and then in the Bay Area, in Greater Portland, really we focused in the Tigard and Beaverton submarket. So that's a really dynamic location because it's about 20 minutes west of downtown Portland. So you can still commute into work. There's a rail line called the Max that's a straight shot downtown, but it also has very strong employment. That's where Nike's headquartered. It's where Intel is headquartered. There's a lot of other robust employment there. So similarly, first ring suburbs, similar strategy, B minus, C plus housing. Once we're finished the renovation, it's B plus housing. And currently to date, the fund has sold 7 of the 8 assets. We still do have 1 property in Fremont. It's Park 88. It's an 88 unit townhome style property. And again, the fund had raised about $13.5 million. And to date, we have made 23 distributions totaling nearly $25 million. And we still have 1 asset remaining, which the fund has about $2.5 million invested. So obviously we need to sell the last asset, but all indications are we are going to meet or exceed the targeted returns of a 16 to 18% investor level IRR. So here is just the fund track record to date. These are the properties that we have sold. As you see, all of them performed extremely well. The lowest performing was at 18.69 deal level IRR. So if that's the lowest, then we're fine with that. I know many of you are asking what is your personal IRR or annualized returns? We really can't calculate that until we do sell the last asset. But again, all of the deals are performing. The lowest performing deal was a 13 IRR, not the 18. But still, when you take the blended returns, the portfolio performed exceedingly well. And so, with that said, Fund 1 is almost finished. It's doing quite well. All of the investors that we've spoken with are very happy. And then we are currently in the process of raising money for our 3rd fund. Fund 3 has currently investments in 15 assets. Ultimately, it will probably be spread over 17 to 19 different properties. And here's the existing Fund 3 portfolio. And as you'll see here, it's really the same value add strategy, but as we've matured as a company, we are now moving into new regions. So Fund 3 has investments currently in Oregon, California, where we've always operated, Colorado, which we've been very active there over the last couple of years. And then we also have recently opened an office in the Southeast that covers Georgia, North Carolina, South Carolina, and Florida. And so Fund 3 has investments in those states as well. As you can see here, we're targeting an investor level IRR of 12 to 15%. And one thing I do want to, over a 6 to 8 year period, and one thing I do want to point out is the IRR is not your annualized return. It's actually lower. The IRR discounts future cash flows. So your annualized return will actually be higher than that. And again, when you see our track record, we historically have underpromised and over-delivered. And I'm fairly confident we'll be able to do that again for Fund 3. One of the benefits of investing in Fund 3 at this time is that we already have 15 seeded assets. So when you invest in a value add deal, the kind of deals that we buy, oftentimes it may take 18 to 24 months for the property to start throwing off meaningful cash flow. As you see here, we've acquired multiple properties in 2021. So that timeline is accelerated for an investor. So Fund 3, we anticipated to be able to make distributions in January of 2023. So if you invest before we close the fund, which is November 18th, you'll start receiving distributions shortly thereafter. And those distributions will just gradually increase as more and more of the assets become stabilized. And as you see here as well, we are, we do incentivize larger investors with a slightly increased percentage of the profits. So this is just, in commercial real estate investing is, I'm sure all of you know, the value of the asset is really just a function of how much income it generates. So our whole model is to acquire properties with a clear path to upside. So we can then increase the rents, control the expenses, and then ultimately push the net operating income. So this is Fund 3's 2021 acquisitions. Obviously, the deals we bought this year, we've only owned them for a couple months, so we haven't, gotten through a meaningful amount of renovations yet. But as you can see here, in a short period of time, we've been able to push the NOI fairly significantly at these assets. And the one outlier, the Russell, that was actually a fully stabilized asset when we acquired it. It's 2017 construction in beautiful condition. We were just able to pick up that property. There's a very motivated seller. So we were able to pick up that property at what we believe is a significant discount. So that said, we'll take any questions that you guys have. You can ask them in the Q&A box or the chat box. Max is here with me as well. And if you have any questions about the remaining assets, our existing portfolio, what we're seeing in the market in general, given the kind of economic climate, we're happy to answer. Max, do you have anything to add that I
No, not really. I think you hit on all the points. Fund 1 performed great. We have one asset left. It's out to market. It's a grind out there. As most of you know, the market has changed again in the past, kind of like 4, 5, 6 weeks. So we maybe just missed the market with that one, but we have a couple of interested parties. So there is still a possibility that we find a buyer in the next few weeks and close it, probably not by year end, which was our goal, but Q1 of next year. And then we'll close out Fund 1. And now we're just raising the end of Fund 3, and we'll also be launching Fund 4. So if for whatever reason you're not interested in investing, you're interested in investing, but not in Fund 3 for whatever reason, Fund 4 will be an option. You can get some seed level economics, and that will launch December of this year or January of next year.
That's a, oh, I'm sorry.
No, go ahead.
Oh, just to piggyback off of what Max mentioned for Fund 4, we have, so if you invest later into the fund, like you would be investing it if you come into Fund 3 at this point, the benefit is you don't have to wait as long to receive distributions because you're investing in a ready-made portfolio. We already have the majority of the assets, and those renovations have already begun. However, what we do to counteract that is when we launch a new fund, like we'll be doing with Fund 4 in January, we do give early investors better economics. So we haven't finalized the Fund 4 docs yet, but historically what we've done is given a slightly higher preferred return. So an early investor would get a 10% preferred return versus an 8% preferred return, and 76% of the profits instead of 74% of the profits. So we have some investors that are motivated by cash flows, so they prefer to invest late in the fund's life cycle. And we have other investors that are motivated by just getting the best economic package they can get, and they're motivated to come in early. So it's beauty's in the eye of the beholder. And then, yeah, we'll move on to some questions.
Okay.
Do you
I'll run through the I'll run through the questions.
Okay, great.
Do you anticipate any change to your strategies in the near future? For example, raising 100% equity for a building that maybe is new construction and has no cash flow and seller must sell. That's a good question. I don't think we would ever buy 100% equity because that is a severe negative impact to your returns. We'd want to at least put 50% debt on something at least. So something like that we wouldn't do, but on that note, we would definitely, we're considering, or not considering, we are actively putting less leverage on properties because of the tumult in the marketplace and just what's available. We are selectively, we're buying more selectively than we were 6 months ago, just really being very careful with what we look at and being more selective with opportunistic purchases. In a market like this, there could be a little bit of pain. So like, for example, we met with somebody this morning who's a developer. He's a merchant developer, and I shouldn't say pain. He's definitely not in pain, but he wants to get out of an asset that they recently developed and they stabilized it, but now the debt markets are upside down. Their construction loan is coming due, and they're willing to sell it at a very fair price and carry some paper. So there's an opportunistic play there. And we're also able to do an entity sale. So we are able to save a significant amount of money on property taxes. You save about $500,000 on property taxes. And on a 5-year hold, that's pretty significant, $2.5 million in additional profit. So there's some interesting plays out there, and that's how we're going to be taking advantage of the current marketplace and changing our acquisition strategy. Second part of that question is, how are rents doing region by region? Rents have essentially flattened out. In some places they're softening. You're seeing the most amount of softness in places like Phoenix and Vegas. We don't do business there, so we're not seeing that in our portfolio, but there's a lot of softness in those markets, but they had a huge run up. So, for people that bought in Phoenix 2-3 years ago, 4 years ago, they're still going to do A-okay. Next question. What are you targeting for Fund 4 in terms of markets, property size, etc.? Fund 4 is going to be fairly similar to Fund 3 in terms of strategy. We'll probably add a couple more states, maybe add New Mexico and possibly look into Albuquerque. That doesn't necessarily mean that we will buy there. That just means that's an option. So if we see some interesting fundamentals in a market such as Albuquerque or possibly, Boise, Idaho, again, not that we would necessarily buy there, then that gives us the latitude to purchase in those markets. I think property size and most of the other attributes would stay the same. The main difference in strategy for Fund 4 will be additional markets. Next question. Can you show again the slide for the payout bands for different sizes of investments in Fund 3?
Yes, I scrolled to that one. So it's actually, I apologize, that is a typo. The minimum investment is 50,000, but 50 to 250, you get 74% of the profit. 250 to $1 million, 76, $1 million plus, 78.
What are the average cash on cash returns for the funds? That kind of depends on interest rates, but we typically get 6 to 8% cash on cash. in a high rate environment, mentally, I would prepare yourself for a lower cash on cash return. Although these high interest rates won't last forever. So on a 5-year fund, we'll probably have high rates for only 12 to 18 months. So yeah, do with that what you will.
And with, so the way in fund 3, we'll likely start distributing in come January. And those distributions will just gradually increase as more of the assets become stabilized. And then when we start selling assets, probably maybe the back end of 2023 or early part of 2024, that's when like the meaningful distributions will start, when we start having refinances and exits.
Are you planning on entering the Austin market? And if so, when? We have been to Austin a few times. This would be a good time to enter Austin because Austin also had just a massive run up. And I don't want to be a part of that herd. We don't want to be a part of that herd. So we'll probably start looking at Austin again over the next few quarters with prices soft. We spent a lot more time this year looking at Dallas than in Austin. We went to Dallas several times. We wrote a lot of offers, underwrote a lot of deals, and we will likely enter Dallas before Austin, but Austin at some point we will inevitably enter.
Great.
Andrew, can you scroll to that slide that shows Fund 3 assets and some of the NOI growth?
Yes. Oops, sorry.
So for anybody who's interested in investing in Fund 3, this is important. As Andrew said, NOI is a very important part of a property's value, and we've already gotten quite a bit of lift through execution of our renovations and value add strategy. And, as you could see, something like Altamont, that's actually incorrect. We acquired that this year. That's 4/1/2022. We've only owned that for about 6 months, and we've already gotten quite a bit of NOI growth. Charleston's cranking. That's now called Latitude at West Ashley, and that property we've turned a lot of units, had a lot of renewals. A lot of people were paying $800-900, and we gave them renewal offers at $1,200, and they accepted. Others who did not accept, they left. We were able to renovate the units and get tremendous growth. And you could see that, across portfolio. Fayetteville, we caught some phenomenal market rent growth there, and we bought a property that had rents, a substantial amount of rents at the asset were, $700, $800, $900. And now we're 1,100 on the low side for 1 bedrooms, all the way to 1,500, 1,600 for 3. So the property is doing very, very well. Looks like we may have gotten a couple more questions. How have your underwriting assumptions for exit caps changed since the rise in interest rates? We changed them by about 25 to 50 basis points. We didn't have to change them by too much because we already assumed higher exit caps. We didn't believe that the market that was happening in, late 2020 to early 22 was going to last forever. So we already blew out our exit cap. So now we added about 25 to 50 basis points. And I think cap rates relative to where they are right now probably will come back in over the next couple of years too, but we're not underwriting that. We're just being conservative. How many of the Fund 3 properties have already been renovated and refinanced with longer-term advantageous interest rates before the recent run-up? A lot of them are pretty far along in the renovation, but none have been refinanced yet. 2023 will be the year where we refinance a lot of Fund 3 properties and Fund 2 properties for that matter.
Anybody else has any questions, feel free to type them in. If not, then we could just keep it short and sweet. And if you do have any questions after this, feel free to reach out to us via email or telephone. We're happy to always chat.
Great. Thanks, everyone. Appreciate your time, and feel free to follow up with calls, emails. If you have any questions, we're here for you.
Great.
Thank you very
Thanks,
much.
guys.
Enjoy the rest of your day.